Welcome to This Explainer. If you've been watching the logistics space lately, you already know we're in the middle of a highly unusual, honestly, kind of confusing environment. So today, we're going to jump right in and decode exactly what is happening in the 2026 freight market using the latest data. So let's look at this massive contradiction right off the bat. Spot rates are climbing, capacity is super tight, but consumer spending on physical goods is actually down, and really, nobody is shipping more freight. Normally, right, you'd expect prices to spike when everybody is rushing to ship products all at the same time. But the economy isn't exactly booming with new freight volume right now. So what's actually causing all this pressure? Well, analysts actually have a term for this whole situation. They call it a supply-driven recovery. Basically, what that means is this rate spike is happening simply because trucks are leaving the road, not because consumers are suddenly going on a massive buying spree. The market is recovering its pricing power for sure, but it's entirely because the supply of available carriers is shrinking. It's a fascinating and, pretty challenging dynamic to navigate. So here's our roadmap for today. We're going to break down the paradox, look at how muted demand is meeting inflation, dig into the supply side squeeze, compare spot versus contract rates, touch on some emerging risks and tech, and finally wrap it up with a solid shipper's playbook. All right, let's kick things off with Section 1, the 2026 Freight Paradox, a market completely in contradiction. I like to think of this as supply oversteer. Imagine you're driving a car. On the demand side, the engine just isn't revving. We've got sluggish volume and really lean inventories. But on the supply side, the brakes are completely locking up, with plummeting capacity and soaring costs for carriers. These two opposing realities are colliding right now to create this entirely unique environment we're operating in. Moving right along to Section 2, muted demand meets inflation. Let's look at the specific economic headwinds causing that engine to stall out. When we actually look at the data, it's pretty clear that overall freight volume is just sluggish. I mean, the ATA tonnage index completely flat in April, and the Cass freight index has been stuck in contractionary territory for 14 consecutive quarters. That is a long stretch. Plus, we're still seeing this post-pandemic trend where consumers are spending on experiences and services rather than physical stuff. Add in the fact that businesses are running incredibly lean, keeping that inventory to sales ratio down to 1.32, and you realize nobody is hoarding safety stock right now. Shippers aren't the ones driving these rate increases. We also have to neutrally factor in the recent Supreme Court ruling striking down the IEEPA tariffs. While average effective tariff rates dropped, it actually injected a ton of sudden lane-level volatility into the mix. So shippers aren't magically moving more volume overall. They're just scrambling to reroute and adapt to these sudden policy shifts and changes in customs costs. So if demand isn't the driver, what is? That brings us to Section 3, the supply side squeeze. This is the real driver of 2026. 194,000. That is a massive number. That's the FMCSA's estimate for how many drivers have been pushed out of the market due to the strict new enforcement of non-domiciled CDL rules. Honestly, this is probably the biggest structural change to the U.S. carrier market since deregulation back in 1980. With these stricter verification processes tied to immigration status and English proficiency, a huge chunk of the driver pool has simply evaporated. But it's not just the CDL crackdown forcing carriers out. Think about the basic operating costs. Diesel fuel prices shot up 62% early in the year. Then you've got insurance and financing costs absolutely soaring. It is incredibly expensive to just keep a truck running right now. As a result, W-2 driver employment at the large fleets has been steadily dropping for over 34 months. Put all that together and you see exactly why capacity is so incredibly tight. Which leads us perfectly into Section 4. Spot rates versus contract, and how this supply squeeze is directly impacting your wallet. Just look at this shift. Spot rates have finally overtaken contract rates, surging to a 16.5% year-over-year growth in Q1. For the last couple of years, shippers definitely had the upper hand, pushing contract rates down. But as capacity bleeds out of the market, the spot market is spiking dramatically. And here's the catch. When spot rates get this high above negotiated contract rates, carriers naturally start rejecting those contracted loads to chase the more lucrative spot market, which means your carefully planned freight budget, that can go right out the window. Now, aside from just rates, there are some major external variables we need to keep an eye on. Let's look at Section 5, Emerging Risks and Tech. 18%. That's the year-over-year spike we're seeing in cargo theft, fraud, and extortion across North America. Bad actors are getting way more sophisticated and actively exploiting digital freight networks. It's a huge operational risk, which means logistics teams have to prioritize strict vetting and continuous tracking to protect high-value cargo. Speaking impartially here, we also have to look at the recent Supreme Court ruling in Montgomery v. Carib, because brokers can now be held liable for negligent hiring if a carrier they select is involved in an accident. They are heavily scrutinizing safety ratings. Smaller brokers might struggle to afford the insurance, and smaller carriers without literally perfect safety records are going to find it way harder to get loads. This just shrinks available capacity even further and will likely accelerate industry consolidation. So, how is the industry responding to these labor shortages long term? Well, they're trying to innovate their way out of it. The autonomous freight truck market has hit $575.7 million in 2026, and 64% of those applications are dedicated directly to logistics. It's still a fraction of the total market, sure, but companies are aggressively testing AI-powered driving systems to optimize long-haul transit and reduce that reliance on human drivers. And within that autonomous slice, traditional diesel fuel still dominates at 72%, but new energy vehicles are capturing a growing 28% share of that self-driving fleet. So as we inch toward a more automated future, we're also looking at a more electrified and sustainable one, kind of combining two massive technological shifts into a single solution. All right, let's bring it all home with Section 6, the Shipper's Playbook. How do you actually navigate 2026? Here is your 1-2-3 action plan. First, strengthen your primary routing guides and lock in reliable capacity right now to avoid that crazy spot market exposure we just talked about. Second, build corridor playbooks. With all the tariff volatility and weird weather events, you can't just rely on one macro global strategy. Treat every major trade lane like its own unique scenario with backup plans. And third, actively monitor carrier risk and diversify. With cargo theft up and new legal liabilities in play, you've got to vet your carriers deeper than ever before. Let's take a quick look at the timeline of how we got here. We started seeing the market tighten in mid-2025, hit that massive regulatory wall with CDL enforcement in March 2026, and saw spot rates hit multi-year highs by May. Now, analysts at FTR project that this persistent overcapacity and market imbalance won't fully ease up until 2027, because there's still a heavy population of small, independent carriers hanging on. The true return to a balanced market is still on the horizon. I think this quote from ACT Research really hits the nail on the head. The environment remains defined by transition rather than acceleration. That is exactly it. We are finding a new baseline. It's a rebalancing act, where the excess capacity from the pandemic years is finally burning off, but it's happening through painful attrition, not some joyful economic expansion. So, I'll leave you with this final thought to chew on. As the supply squeeze continues to tighten, how prepared is your supply chain for the 2026 rebalance? I really hope this explainer helps you adapt to the road ahead. Take a close look at those routing guides, talk to your carriers, and whatever you do, stay agile out there.